But the first panel session is hosted by Paul Saliba, and so I'll get him to come up to the stage with Jason from Resonant and Sudhir from Allan. What I love about Paul Saliba is he is the world's best at dad jokes, but I'm going to ban him from that today. So welcome to the stage.
Good morning, everyone, and welcome. Yes, we believe in active, and here's how we know it works. We've got a panel today with myself, Jason and Sudhir. So if we can welcome Jason from Resonant Asset Management and Sudhir from Allan to stage, that would be terrific. Big round of applause for the two panellists. And here's how I know it works while they're coming to the stage. Who here is paid, has their remuneration paid via units of a passive index fund? That's no one, right? So we're all paid in cash. Back in the day when I was younger, it was cash in a little envelope and you had to count it and make sure it was right. And I can see a few smiles around the room, so you sympathise with that. And then you had to work out where to put that cash. Normally, the first instance, it was in the bank account. Excuse me, I've got a bit of asthma and it's affecting me. And so that cash went into a bank account by your own decision, and thereafter you made decisions about where to put that cash. Today we're paid to our bank account. It sits in the bank account, accumulates if we're lucky, and once it's accumulated, we decide what to do with it. Be it equity markets, be it bond markets, whatever it is, that's an active decision. An active decision is also what combination of those things that you buy. And so to me, we know that works because there's active returns from bonds and equities. There's factor returns from bonds and equities. And so that is a way of saying that active is just the decision to invest in markets, and that is what we all do. And so today, Jason and Sudhir will explore the ideas of how they see active investment, different ways of doing active investment. So I might pass off to Jason first to talk about Resonant and how you think about active investment.
Thanks, Paul. So Resonant are a multi-asset manager. And I think one of the slightly different ways that we approach the concept of active is that starting at the very top level, I'm sure everybody in the room is basically implementing some form of SAA. So in the first instance, your SAA basically is an active choice because not all SAAs are the same. So I think by default, everybody's probably agreeing that there's a level of value because otherwise we wouldn't be doing that. When we then go to the next level of implementing DAAs, we're big believers in that, and a lot of our process is built around those asset tilts. I guess to give you an idea of what we typically are looking to achieve out of that is somewhere between 50 and 100 basis points of value add over a long-term cycle. And then when you go down to the next level within a multi-asset portfolio, moving into whether it's interaction, if you look at Brinson breakdowns, selection and choices within those sectors. So again, we look to add value in there, but I think what's probably slightly different for us is, and we see a lot of the traditional active passive debate, that when we look at portfolios, we sort of break everything, we'll sort of throw everything into the mix and sort of say, well, there's times that active will work, there's times that passive will work, there's different products and options available to us that we can put into these portfolios. So a lot of that really comes down to trying to look at regimes, understanding when different styles might work, when different strategies will work, and really pulling all that apart and then trying to build the best multi-asset portfolios that we can using that full available open architecture and tool set. So that might be, for a period using a tilt or using a passive ETF to actually go into something, or you work around a active manager as a core allocation. So keeping yourself very flexible in our view is how you actually implement that active approach, and really keeping an open mind on what's going to be the best solution for what you're trying to build. So.
Terrific. Sudhir, you work in a research capacity at Allan. So talk to me about, and to the audience about, your approach to being active.
Yeah, thanks, Paul. I guess, maybe I'll start off just by addressing, the first part of the topic for today and, why we believe in active. And I know I'm talking my book here, but if you were to maybe take a leaf out of the late, great Charlie Munger's book and try to invert the situation and say, well, what does the world look like if we were purely passive and there was no active investment? I think then we end up with some perverse outcomes where, in that sort of world, capital will be allocated to the largest stocks because, that's effectively how an index investment might work, and not necessarily to the companies that produce the best returns. And I would argue, from a societal perspective, that's not necessarily the outcome that we want to solve for, because we want capital to flow where the best returns are available, because that's what creates long-term productivity for us as a society. So I guess that's a long way of saying that 100% passive doesn't necessarily work. There is a place for passive, and I think there's a place for active. And when we think of active, we then think about, well, if there's a place for active, where should that active money be going? And when we look at what we've done as a firm, so we're a long-only active manager focused on Australian equities, but we're part of a larger group which invests in global equities using exactly the same sort of strategy and investment philosophy. And over the longer term, we found that strategy has worked well. So, the Australian Equity Fund over the last 18 years since inception has outperformed the benchmark net of fees by about 2.5%. And other funds within the group have outperformed as well. And I think that's because of the sort of three legs to our investment philosophy, and that is being contrarian, being fundamental, and taking a long-term view. And the reason that we're contrarian is because, as far back as you can look, markets have been driven by fear and greed. And so, when fear takes hold, we think that a lot of stocks can get sold off to a level well below fair value, and there's an opportunity for us as bargain hunters to get in there and buy those companies at a reasonable discount. But you can't just be contrarian for the sake of it. You've got to be buying companies that actually offer good prospects, and so that's where the fundamentals come in. And so we're looking for companies that actually produce a product or a service that the world needs and will continue to need. Companies with good balance sheets that generate strong cash flows. Those cash flows are growing, good returns on capital. If those things are in place, then we're happy to take a contrarian bet because we think that's a company that offers long-term investment potential. And it is important to stay long-term because some of these companies that get sold off, the irrational, emotional drivers that cause those share prices to fall below fair value, that irrationality can persist for extended periods of time, sometimes years. And so, we take the view that we're happy to hold those companies for a multi-year time horizon in order for those fundamentals to reassert themselves. So just to summarize, we take a contrarian view, we buy stuff that's disliked, provided that there are good fundamentals in place, and then we're happy to hold them for the long term until the fair value is realized. So I'll stop there, Paul.
Terrific, thank you. Jason, one of the things that we all know is the famous SPIVA reports. So for those of you who don't know, the SPIVA report kind of highlights by asset class the propensity of managers, I suppose, to underperform the respective benchmark over periods of time. And if you look at the long term, it's in the vicinity of 70-80% of managers underperform their nominated benchmark, passive index. How do you factor that in? One of my views has always been, yes, any one manager might in time be likely to underperform, but for periods of time and for extended periods of times, different styles, different strategies can outperform. And if you can go from manager to manager who outperforms over time, then you can do well. Talk to me about your views around that and how you think about managers and the reality that Spiva report tells us.
Yeah, thanks, Paul. So I think what we need to keep in mind is that alpha in its pure form, and I'm not talking about alpha in terms of, say, a growth manager outperforming the MSCI World versus genuine alpha versus their styles. It's actually exceptionally rare, and I think if you probably broke it down based on styles, probably be even higher than 80% in terms of those that underperform. So you've really got to pull apart what a manager is doing. You've got to look at their drivers, their style drift. You need to look at team stabilities. I mean, I think we all know what a lot of those variables are. But we also need to accept there's actually managers out there that are probably not. They're probably either past their peak in terms of what they've added. The approach that they were taking was maybe just something that worked well for 5 years. And also the market is always shifting and it's extremely competitive. We all know that. So, keeping on top of their process, it could be technology, it could be information, it could be like tapping into, specialist networks and having their information edge, whatever that edge is that drives their outperformance. Are they retaining it? Are they reinvesting it? Is it, and generally, in my view, it comes down really to people, not really process. So you want them to stick to a process, but it's really people that are ultimately going to drive that. So we do want to understand in active managers, are they actually making those right decisions with looking after the people and the teams, getting consistency and style drift for us is one of the big things, or big shifts in individuals or changes. So ultimately, we think it is there, but you've really got to go looking for it and pull the curtains open. So.
Terrific. Now, we are happy to take questions for the floor, so just raise your hand. Is there a mic somewhere around for questions? So I'll go to Sudhir while people are thinking of some probing questions for our two panellists. Sudhir, value's had a terrible time for many years. What is it about value investing in the equity side that keeps you going day by day when it's been so challenging for such a long time?
Yeah, some days are much harder than others. We don't really know exactly what's causing it. I mean, there are a few hypotheses out there. People talk about low interest rates causing, a shift more to growth style investing, more of a move to passive potentially, also causing money to flow away from value style strategies. And I think, there is also quite a strong hypothesis that suggests markets have become more inefficient over time. Because there are more retail investors, more day traders. It's much easier these days to just get onto your phone or your laptop and you can trade any number of stocks all over the world at the click of a button. And so it's sort of causing this dislocation where markets are becoming more inefficient. And we see this dynamic where if markets become more inefficient, it takes longer for that inefficiency to be worked out of the system. And so we just find that it's probably taking a lot longer for value style strategies to find that inflection point where the fundamentals start to come through and the intrinsic value is realized. And so, we as a firm have set ourselves up to be able to ride out these sorts of storms. So, for example, we try to maintain quite a healthy cash balance on our balance sheet so that if we have these periods of prolonged underperformance, but we have high conviction in the positions that we've taken, we feel comfortable that we've got the liquidity to stay afloat, to not be tempted to, move towards a sort of style drift that Jason was alluding to, where if you feel like your survival as a firm is threatened by this kind of long period of underperformance, you may be tempted to start investing in the sorts of styles that are currently working. That's not something that we want to do. So we try to set up the firm in a way that we can ride out the long periods of difficult conditions and hopefully come out stronger on the other side.
Terrific. Any questions from the floor at this stage?
Paul, sorry, can I just add one thing to
Yeah,
your
absolutely.
question?
Sorry, before Rob goes, so the microphone will make
sorry,
that
Rob.
way. And
I've just got a view on this value thing that, in my view, it comes down to private equity, right? So, private equity have effectively filled that void of going around looking, and these are big companies, right, that can go in and say, okay, well that's cheap, we like it, that's out of play. So if you're a value equity investor, your opportunity set has been destroyed. So now if that does full cycle and it comes out in private equity, you get too levered and blow it all up, then that's fine, that'll create opportunity again. But the issue is that when you have your opportunity set taken away, it's very hard to do your job.
sure. And the number of listed securities in the US, as an example, has markedly fallen over the last 20 years, and that's a case in point. Rob, over to you.
Thanks, mate. So firstly, a sort of mini rant about the Spiva report, so thank you for introducing that topic. I think... Yeah, I think they recognise these flaws with two main ones. One is that an index is not real money being managed in the marketplace. Doesn't recognise cash inflows, cash outflows, market impact, and restructuring of the index, etc. So using that as a target for fund managers managing real money is, I think, unfair. What should be done is target benchmark against an ETF or an index fund that is actually running real money, which takes into account transaction costs, all the rest of it. Secondly, they use a standard benchmark for all the funds in the group, regardless of whether those funds are actually benchmarking themselves to that index. So I think it's the ASX 300 for the large cap Aussies. And there's a lot of funds that don't track the ASX 300 directly, and that makes a meaningful difference. So I don't think that that number that's bandied around so much, 70, 80, 90%, whatever, is strictly, accurate in that sense. It's accurate the way they calculate it, but I don't think it's a real world example. However, even they recognise that there are other sectors in the market where there is value being added, and I'll highlight small caps as an example, where regularly small cap managers outperform the index by a decent margin. So I'm just wondering, Jason, it recognises, and I believe this again personally, that efficiency in the market is not an all-encompassing universal principle. It depends how efficient a market is different across various markets. And in terms of putting together asset allocations, etc., that provides an opportunity for looking at where you can find inefficiencies and trying to tap that. Is that part of your approach, or how do you think about that?
Yeah, absolutely. I mean, your example with smalls, we see that as that is a key alpha driver. There's a small cap index composition issue in the way that you get a whole lot of crap in there, to be honest. But generally, we're looking for a small cap manager. I mean, really, 10 years ago, you'd really look for your small cap managers in Australia probably doing 7 to 10% over. Right now, it's probably more about 4 or 5 and that's probably a baseline, right? So you can make those adjustments. What's quite interesting is, previous life I worked at Pendle with under Crispin, and I mean probably the biggest barneys you'd ever see is when there were fights over getting allocations to mid and small cap, issuance, right? Because that's sort of the free ride. So a lot of your large cap managers are still using that, what is effectively quite inefficient part of the market, to get their return boost. So that's quite common.
I thought Rob was going to offend not only S&P but also all of our fabulous ETF sponsors.
Being S&P, Dow Jones Indices, the rep here, I think I need to make a comment in response to Rob. I don't want to take up too much time, and I'm happy to speak to you directly, Rob. But in terms of the benchmarks used in the SPIVA report, we do not actually decide on what benchmark should be selected, and I think we should reference CFAs and their GIPS standards as well, where there are market indices used. We sourced information for Australian SPIVA for Morningstar, and they have a large part to do with the categories in which we report. We don't necessarily pick and choose, but we can discuss that in greater detail during the break.
It's all right.
All right. Yeah.
Other questions?
Any other questions?
The girl in the high vis got a question. Jason, I think you talked about, each underlying asset has a particular role in a portfolio, and I often hear about the discipline of when you take out a stock, etc., and that process. I just want to know the discipline behind when we take out a fund, and what's the information, and what sort of process do we go to when we have the discipline of removing a fund and replacing a fund?
Sure. So I guess the best example I can use, this can sort of go down a whole lot of different rabbit holes, but I'll use an example of international equity fund where you've got it in there for a particular role, and I'm going to say it's growth. Now, we would be looking to try and we will allocate 2 benchmarks when we're measuring that position. One will be their official benchmark, and then exactly to Rob's point, we would be using some sort of ETF, which is likely to be a growth ETF, as a secondary benchmark that we're looking for them to consistently, to a degree, consistently outperform. Now, if they're not outperforming that as a period of underperformance, then we're going to ask questions about, well, why has that happened? Sit down with them, understand it. It may be down to a single position, it could be a bad call, but if you're talking about team changes and things like that, then that's sort of opening up potential for changes. But the way that we would look at that on a broader basis, growth's maybe not working, that doesn't bother us, right? As long as they're sort of either keeping up, because we'll make other changes elsewhere in the portfolio to compensate for that. So ultimately, we're going to look at, are they doing the job within their lane, and assessing them around that. And we measure that lane not just off their official benchmark.
Terrific. Any other questions?
Yep.
One on the back here. I can't quite see in the blinding light, but that's...
Yep.
Thanks, Robbie. Sudhir, as a value manager and a conviction manager, have you noticed, and with the inefficiencies that you're talking about in the market, with day traders coming in and smaller people coming through the system, have you noticed whether there's been a time frame factor in the value stocks that you pick that has changed because the dynamics of the market is moving so quickly? And sometimes you can get a very big firm that you've got good conviction on, can have an event that suddenly makes a dip in the market, and you start to think, how long do I have to wait for this to come back again?
Yeah, we have noticed it probably from 2 perspectives. So, sometimes we see stocks that have this, sort of fall out of favor and have this extreme drawdown in share price. And, typically we try to build a position in those types of stocks, but sometimes we can't really build a large enough position before that mispricing gets, that gap gets narrowed and the price goes back up to the fair value. And, that sort of speaks to the idea that there's more information available out there these days, and the information is more accessible. And so sometimes, that information asymmetry can get competed away quite quickly. And then at the other end of the spectrum, we have the opportunities where it's not so much about the availability of the information, but more just the company might be going through a really rough patch. And so it's not really the information that people are looking for, it's just waiting for the uncertainty to dissipate. And those are the ones where, it can take a really long time for that uncertainty to play out and for people to get more confidence and then start buying the company again. And I think in those situations, we're finding that it sometimes is taking a lot longer for that to happen, because more capital seems to be flowing into the companies where there is a positive story, there's a feeling of certainty around what the future looks like for the company. And so there is this inertia for capital to flow away from the good news stories into the companies that have had a bit of bad news and have turned themselves around. And I think that's also what's causing us to have to take a much longer time horizon than we might have done 10, 15 years ago.
Paul, there's a question from the live stream. We are live streaming this, so I should have said welcome to those of you on the live stream who are watching this. So the question is for Sudhir, which is you mentioned that you carry a sort of significant cash holding. Doesn't that affect returns for the portfolio overall?
Sorry, I should clarify. So that's not cash within the portfolio. That's cash, us as a firm, the cash that we carry to fund the business. So that's separate to the portfolio. And the reason we do that is because, as a firm, we want to make sure that we have sufficient liquidity to meet our expenses if we have a period of sustained underperformance, because a large portion of our fee income is performance related. And so if we don't outperform, we don't generate the fees. And so we need to make sure that we have sufficient reserves to ride out those periods. So that's really what I was getting at there.
All right, and I have a question, Jason. This is more for you. I mean, most of this conversation about active tends to focus on listed equities, but that's only 25-35% of a typical portfolio. So, as a portfolio manager, how does Resonant think about, on the one hand, active versus passive in the other big section, fixed income, which is, after all, the bigger market, and then in the private markets, alternatives, unlisted space?
So fixed income, depending on your mandate, etc., notoriously difficult at times to outperform. I won't name who I was talking to about this, but they said, fixed incomes the bonds are actually the easiest thing to outperform now, you just stuff it with credit. So we'll see how that works out. But that's the playoff that you're probably dealing with now is, are you going to try and manage your fixed income more through duration, or are you actually going to start taking on credit risk? So at arguably a point in the cycle, things are pretty tight. So that's probably, and then looking at how the manager's going to approach that. So for us in fixed income space, we really want to manage it to have flexibility. We would be very unlikely just to say allocation to credit and then hope it works out. We'd be saying active manager that's got good background in prop desk hedge fund that's now managing more of an institutional style portfolio that could move across to either a lower risk allocation or has got multiple levers to pull. So that would be that space. Alternatives, we're users alternatives. We're big believers in it. You've got to pay for it. But again, you're trying to build something that complements, and we tend to build quite defensive style alternative allocations. So things that we see are going to work well in markets that are either high volatility or moving south. So CTAs, relative values, market neutrals, things like that.
And that's another interesting point is you're looking at certain time frames, and whilst SPIVA or any other notion of active doesn't work and you underperform, you're trying to mitigate risks in the short term or in the medium term. You're trying to get performance in the short and medium term. How do you think about the time frames?
We're monitoring correlations between all those holdings. So, and I guess they're sort of over-rolling, maybe 3-year periods in terms of the way we look at that. So that probably gives you a bit of an idea, I guess, about the time frame that we're mainly concerned about. We're not. We tend to work to a 30 to 40% turnover target. So there's only so much you might want to react, but there's limits to how much you can genuinely do. And really the evidence is that if you go past that sort of 40% turnover, you really start chewing into returns through transaction costs, etc. So there's the natural buffers in there that allow you to control that. But looking at those maybe regime shifts within a time frame, they are pretty slow moving. Like they don't happen overnight. So it's a matter of trying to pick that up, and it's an art, not a science. So.
Sure. Any other questions on the floor? No, we're all good. Sorry? No, time. All right. Thank you very much to our panellists. Thank you to the audience for your questions. we'll hand it back to Francie. Thank you all.